Right, I think we'll kick off. Like I said, we are expecting over a couple of hundred of people on this call today. But Joe, it's great to be with you. Thank you for taking the time first thing on your Monday morning to be with us. It's great that, you know, first prize would be to see you face to face, probably not at the moment, but under normal circumstances. But yeah, it's great that we can do this. I'm Brian Duplessis, Head of Marketing and Distribution at Rezco Asset Management. And with me on the call today, I've got Rob Spanjaard, who's our Chief Investment Officer, and Simon Sylvester, who's Head of Research and Co-PM. Just a few sort of house rules per se. There is the opportunity to ask questions. If you look at the bottom of your screen, you'll see a Q&A sort of little speech boxes. We will be manning those. And what we'll do is we'll be answering some of your questions during the webinar. And then obviously at the end of the webinar, there'll be time for some more questions and answers. Simon will be manning that. So it would be great to get his view and pointers as well, insights. And with that, I think we'll move on to the first slide. So it's a bit of a brag slide. Oh, sorry, one more thing. We will be sending out a link at the end of the presentation to you. It will be an actual recording of the webinar as well as the slide deck. So just looking at this, I think the most important thing here for us is, obviously it's great to be number one. You can see all our funds have done really well, but for us, our value trend fund being number one or top quartile, first quartile over 15 years, it's great that the fund's been going through various market cycles. This also indicates a suite of our funds, and you'll be able to see that we've got our stable fund, which of course is our low equity. We've got our value trend and managed plus, which is a multi-asset high equity. And then we've got our equity fund, which is a great building block as it's general equity, but SA equity only. And then of course our global flexible feeder, which feeds into our global fund. All of the funds have done really well. Like I said, it's a nice little brag slide, but we'll unpack some more of that performance a little bit later. So obviously what's important for us is for you to be able to access these funds. We've got great relationships with all these platforms, and what we've really tried to do is put our clean pricing on there. Our C class is on most, for all our funds, on most of these platforms. And also what we're trying to do is get our flat fee, so non-performance fee class on there. If there is a class that you're looking for that isn't on one of these platforms, please feel free to reach out to us and we'll do our best to get that class of the fund on there. I think what's also very nice for us is if you have a look at our client spread and how we've grown the business through the years. You know, this is basically all the key decision makers, or you could say financial advisors that are using our funds. And what's really nice for us is that there's no one advisor that has more than 2.1% of our total assets under management. And then something else which we just thought we'd really like to touch on today, because it's very, very relevant given where we're at in the markets, is how are you building your clients' portfolios? So this is something which we really feel passionate about, and that we think is imperative for you, and the advice that you give to your clients is what funds are you combining in their portfolio? So we've often spoken about diversification and being different. Different, often people think is bad, but if you're different and you're right, that's a great outcome. And basically what this chart looks at, or this table, is it's the Rezco Value Trend Fund, which is our fund which has been going over 15 years. And Fund 1, 2, and 3 are very well-known, very good funds, balanced funds in the multi-asset high equity category. There's actually a lot of money going to these funds. We actually did an analysis and we saw that over 50% of the money in the multi-asset high equity category goes to these three funds. And what you want to try and do is you want to try and blend funds that have a low correlation to each other. And this is just a little exercise which we did, which we thought was a great outcome. Obviously, when you put funds together, you want to, in the perfect world, you want to combine funds that ultimately reduce the risk of your client's investment or portfolio. And an even better outcome would be reducing the risk with an increase in return. And what we did is initially we had Fund 1, 2, and 3, which is the green square there. And we said, what if you reduce those funds from 33 1/3, the three funds in your portfolio, to 25%, and you added another fund, the Rezco Value Trend Fund? And the outcome is actually very good, because essentially what you do is you go have an increase in return and a reduction in standard deviation or risk. And with that, I'll hand over to Rob to take you through how we're seeing the market at the moment and how we're positioned accordingly.
Thanks, Brian, to all our clients there and everyone who was there in the webinars we did in May. It's been really, it's great to have you back, and really appreciate the support and so many people turning out. And it's hopefully we can add a bit of value on we've been obviously watching the market really with a lot of interest, and we're passionate this game of psychology and what's going on. And trying to do some hardcore analysis of it, which hopefully adds value to you. Just adding on one point on that slide that Brian was saying there is, have low correlation is one thing. You've got to do it with low volatility. Otherwise, you get a messy picture, and that's really what we're trying to do for our clients. Through this is the core of the game, and the science and the passion of what we're doing as a business. Our objective, right in the core of our company objective, is to produce risk-adjusted returns for our clients. And we're always thinking on, and you'll see some of that come out in the presentation, what is the upside? That's the potential versus the potential downside. So we try to balance the risk-return reward in that. And that's why we combine some of those funds Brian put up there, 1, 2, 3, a very good fund, brilliant fund. A lot of funds that we admire greatly in our industry, really people who have done it over many years and actually darn good at what they do. Our style, being active allocators, is a bit different, and you can see it in this graph. It's value trend over 15 years. It's a Reg 28 fund. It's a multi-asset high equity fund. And you can see we've tried to balance avoiding the big risk drawdowns. In a previous presentation, we called them these grey rhinos, these big risk events. They're big events where you're just not getting paid to take the risk, so why be there? And try do what we do with less volatility for the client. But also very important to note is that we're not some doomsday fund, kind of black swan. Something really bad's got to happen before Rezco is a great fund to be in. And if you can see from the red lines, obviously the value trend fund there, it does spectacularly well. And it's actually produced great returns in a lot of the bull markets. So 4 to 8 outperformed its peers substantially. 2010 to 2015 outperformed peers substantially. And in this, so we kind of just don't like to have the big drawdowns. But we do really do well when the market accelerates upwards and there's great opportunity to invest. So we're doing a lot of work trying to find those opportunities that our clients can profit from, but we just don't want to take risks that we're not getting paid to take. And so consequently, that you can see is our asset allocation, and that probably makes us a little bit different to most of the competitors, is that we're active asset allocators. So the multi-asset part of what we do, we will vary the asset allocation, and this is just growth assets versus fixed income. The red being growth assets, and you can see we manage it and vary it fairly substantially. And also what doesn't show there is how we move the bond duration. Sometimes worth having bond duration, sometimes it's not. We sometimes have some commodities, how we manage the foreign exchange exposure. We took our Forex exposure down from it was actually at 35% when the Rand blew out. And up until, it was about a week ago, we had taken it right down to about 16% in value trend, the offshore. Reg 28, we can be 30, but we actually, before the Rand, at about 1670, we moved it back to about 30% offshore. So you've got to take and often we talk about it, you've got to score those singles. In cricket terminology, you've got to find those singles to score the runs for our client. And that's what we feel we can do as asset allocators. We can make those things like currency switches quicker than a lot of people out there. So how the fund's done, it's value trend, the red line. The yellow, there's the average CISA fund. So even though the market's rallied since we last spoke, You can see we've actually carried on going up, chugging away, still getting returns for the clients, and so still fairly substantially ahead of our competitors and the averages. And to some degree, we think it's going to be a tortoise and hare market. Just don't have big drawdowns, but still make those returns. So getting back to the cricket analogy, sorry, we're talking Aesop's fables, we're talking cricket. It's not always a time to try hit big sixes. Sometimes you just need to you need to get the singles, and it's a bit that market. Managed Plus, very similar thing, just steady, solid returns. The market rally has still left the average fund quite far behind us. Our stable funds, it's a great fund, doing what a stable fund should do. That's the red line. The yellow line is the average peer group. And you can see the bond, interesting one, the bonds is the blue line, that's the all bond index. You can see the volatility in our bonds. It's a massive hit for bonds, and that's one of the problems in income funds. Income funds have a place, but investors shouldn't think this pure no risk asset, particularly with, or we're going to have this supplementary budget and anything could happen.
Rob, just to jump in,
yeah.
Sanjay is just asking about our view on the performance. One of our competitors saying that balance funds should do pretty well over the next 3 to 5 years. And what are our thoughts? And just looking at these performance charts, I think something that's important to highlight is we view the current environment as a kind of a pretty bad environment to take a lot of risk. So to have the view that from here going forward for the next 3 to 5 years, funds are going to do really well, I'd temper that a little bit and saying it's a good opportunity. We can hit some singles. You can see the performance. Here's the stable fund in front of you. You can see Rezco sold out of risk assets end of Jan, kind of into Feb. But the fund still ticked up. There are still good opportunities that don't take a lot of risk. For example, when the Rand blew out to 19, we sold some Rands and we bought some Rands and sold some dollars. The same thing goes for duration. When the bonds sold off after the downgrade news and the exit from the Wigby, we bought a bit of duration. So there's some low risk plays. The fund can earn a couple of percent, and we can tick along quite nicely in this environment. But to really do very well, to Sanjay's question, I think you need a correction in the equity markets to kind of rebase the buying values to have a really good 3 to 5 year compound. So I don't know what the future path looks like exactly, but I'd temper a little bit of the positivity on a 3 year view. 5 year possibly there's some good opportunities to potentially buy on a dip.
There's a lot of good research. Where you get in is important. We think getting into the equity markets here, probably unlikely to make you money. It's probably got a high probability of losing you money. But there will be opportunities, and it comes back to the old Warren Buffett, Benjamin Graham analogy. You have to buy when everyone's fearful, and the market is not fearful. The market's actually very confident. So we don't think it's a time to buy, and the values aren't great. We're back to close to where we were at the highs in South Africa, and similarly internationally, particularly US market, Europe not so much. And it's a dangerous place given what's going on economically, but we'll unpack that a bit. And obviously, please send through more questions, everyone. We are great to answer. Just quickly, that's our global flexible fund, the red line there, outperforming peers, doing nicely. This is our equity fund. The red line, it fell when the market cracked. It has to be invested. It just fell slightly less than the peer group, being the yellow line, and went up slightly more, which is what we're trying to do, just try to find better equities. So here we get to the roadmap. In the last presentation, if you was there, what we brought out the slide, and for those who weren't, what it was we said, look, there's a recession. However you unpack it, there's a recession going on worldwide and locally. So let's look at the bear markets that had recessions, and we've taken out the two most recent versions, the GFC, which is the blue line, and the 2000.com, the bear market that happened after that. And we said, look, let's just take it. The market never does exactly what it did the last time, but let's put where we are to get some degree of reality. And where we were when we last spoke, we were just kind of at the blue line on the S&P. S&P, big part of the all country world index. World markets don't look much different, but to really just do some sort of justice to the comparison, you were at these levels. Markets, US markets gone up about 10% since then, pretty much back to where it was at the start of the year. We still hold that it's a recession, and we still feel that roadmap is correct, and we'll unpack why we think that. South Africa is the red line there. We're probably about 5% up from where we last spoke. We said it's a great time to de-risk portfolios. We've got one extra recession in there, that's the green line, which is the Asian financial crisis, the emerging market crisis of 1998. And you can see we're back to these levels with the reality of the economic hit that we've had, we think is a great opportunity to de-risk, and we still feel that. And it's not the start of a new bull market. It's very hard to believe that that's the case, that we've got this massive boost in economic growth coming worldwide that's going to cause equities to do really well over the next couple of years. So we come to that question, and everyone's got to make this decision for themselves. Is it a bear market rally? It's a nice rally. It's giving you another opportunity to exit, which is the start of a bull market like maybe 2010, where you're going to have 5 years. Just get in now, and this thing's going to double, treble over the next 5 years. We don't think that's likely, but anyone can make their own decision. And really, here's an example of the US market, some of the reason why. There's the price earnings ratios forward. In other words, what the PE will be in 18 months based on the current share prices. And you can see the blue line here and the yellow line, that's 12 months and 18 months forward earnings. And let me just say something. This is the market adjusting what they think company earnings are going to do. And historically, they're always very slow to do it. So this is the best case scenario. And you can see the market relative is expensive, getting close to where it was in the dot-com bubble at those peak levels, and very expensive. At 22 times earnings is expensive. And so our view is, given the economic risks out there, and we're not far off the highs of the bull market. We had a massive bull market from 2009 right through to the start of this year. Longest bull market in history. We're at the top of the bull market levels. We just need to put that in perspective, because you can't compare what shares are now to what they were a year ago. That's the top of a bull market, and we think very expensive. So it's unlikely that for a bull market to actually start from here. So just as an aside, what's going on here? And this is a little bit tongue-in-cheek. So is it the smart money or the dumb money driving the rally? And so just as an aside, and then apparently Warren Buffett is an idiot. That's according to one Dave Portnoy. Dave Portnoy's got a huge following. Day trader, that's this chap, Dave Portnoy, millions of followers, also known as DAVEY, day trader. And he was a sports bettor. Barstool Sports, obviously very successful. He sold it for 400 million at the start of the year. So he's a clever chap. But there's no sport carrying on. So you can't do sports betting. So let's try shares. Let's buy and sell shares. And DAVEY, day traders, great following. And he bought airline stocks. Warren Buffett sold all his airline stocks. They're pretty much near the bottom of the market. And DAVEY, day trader, bought them, and now he's a genius. And you can see he's got a couple of rules of trading. And you can see on his board in the background there, it's stocks only go up. In fact, he's got 2 rules. I'll put them up now. Rule 1 is stocks always go up. And rule 2 is read rule number 1. Now, we need to be careful as investors that we're not operating like DAVEY, day trader. Shares only go up. The rolling 5-year equities beat anything. It's not at these prices. Shares, we don't think are up. We think there's more chance of them going down. And to give an example here, I'll let Simon. It was actually his chart he pulled out, so I'll let him explain it to you.
Yeah, there's a lot of articles online. Dave Portnoy, this was one of his trades where he claimed to make a few times his money on. This hurts. The company's gone bust, effectively. Shareholders will be warned that they will get nothing for their shares. Don't buy the shares. And you can see the share price at yellow line went up 5 times. And Dave Portnoy, big part of this. But day traders, you guys stuck at home with their government bailout money, no work to do, day trading, following these things. But the bottom there's the volume. And that's what's important. Is the headline is hurts investors, day traders made 5 times their money. The reality is most people bought at the top, because you can see how that volume then just ticks up when it sparks up. And for most people, they probably lost half their money, maybe more, so far on average. So the reality and the headline often differs. A lot of people are losing a lot of money in day trading, although Dave Portnoy is probably a genius for getting a whole bunch of people to follow his trades after the fact and sell to them a week later at a profit. But broadly speaking, there's a lot of hype and noise in the market. It's interesting to look at, but I don't think it should drive our fundamental thinking on valuations. I think the next chart is a little bit more realistic, taking kind of 2000 US small cap, US Inc. effectively, and you can see that PE ratio. That's the reality. And there's a lot of day traders in there pushing up these PEs to kind of a silly high number, having a lot of fun. I don't think it's good to get caught up in that hype.
Yeah, and I mean that PE there, if you can't read it, it's 48. Now what we're saying, it doesn't. Bull markets don't start from here. And it's sign. One of the signs. What is a very frothy market. Weirdly enough, the market's very confident. It's not like the market's fearful. The market's massively confident. Equities only go up. This is like 2010 buyer and it doubles. You can see there you would have bought. You could have bought the Russell at 400 and it went to 1600, made 4 times your money. This is at a new high, or it's not at a new high, but it's at the zone of the high thing. But the shares are massively expensive. So unpacking that, why do we think that? Are we just party poopers? We don't want to get on it. We internally challenge ourselves. We're happy to change our mind very quickly. We're not married to a position. And as I've said, we've had some of our best returns in the bull market. But we're not Davey day trader. We're not gambling. We're not just living by some maxim that shares only go up, because by bitter experience, they go down as well, and you can lose a lot of money. So we're happy to just kind of work out what this is going to do. Now, what is this? This is the world economy. Now, the green line is the GDP, the world GDP. Now, that's not percentage change of the GDP. That's absolute GDP. The green line is the GFC, and the blue line is the April numbers of the IMF, which I think they're going to revise down. And then the red is a slightly worse scenario. Now, this is world GDP, and because China, if you believe the numbers, is second biggest economy in the world. If you believe the GDP numbers, they're going to start, they grew very quickly as they came out the GFC, and they're going to carry on growing at 5-6%. If you look at US on its own, or Europe on its own, Japan on its own, you're seeing a much more muted. The recovery is the dip is a lot bigger, and the recovery is slower. But you can see that the hit is, even on IMF numbers, a lot worse than the GFC. So significant recession, and it takes a lot of time to heal the damage. Part of what we spoke about last time is a recession impacts corporate profits, which impact equity prices. You can't get away from that. Now, that's GDP, the red line there, and the blue is trailing earnings. Now, obviously, companies don't all work straight off the GDP, whether the GDP is up 0.5% or down 0.5%. It doesn't really make that much difference to company earnings. But what does make a big difference is if you're in a recession, it hits company earnings fairly significantly. In a deep recession, it hits them a lot. So you can see there that the GFC, the GDP fell a lot, fell to 4%. Expectation here is that GDP is going to go right down to -6-7, and this is US as just an example. We're just trying to contrast it to world numbers. Get slight. I don't think it's accurate at the moment. And you can see that hits corporate profits. So at the moment it's got forecasting down 20%, could be down more. And part of the rest of our thesis is, look, if earnings fall, and shares are already quite expensive, now that has an impact on share prices. So you can see there with earnings collapse, the blue line are earnings, potentially the earnings could fall 50%, maybe they only fall 20%. That means the shares should be down about 20%, 20, 30%. They shouldn't be 5% up year on year. And that's what we're saying, there's not a lot of upside. There's a lot of downside, and shares might go up another 5, 6%. But you could be down 20, 30, 40%. And that's the risk we're not taking. Here's US growth forecast. As I said, again, this is market forecasts, and these tend to be slow in adjusting downwards. And you can see, interesting thing there, some sectors like consumer discretionary are going to be down 55%. Financials, industrials are going to be down 50%. Financials down 40% earnings. But even the information tech earnings, that's the red line there, are still going to be flat year on year. Now, beginning of the year, the expectation would be 7 to 10%. They now are going to have no earnings growth. So even the Microsofts, they have to still sell to real businesses. The Microsofts, the Amazons, not everybody does incredibly well. On this thing, there's not really any big sector that does well in this environment. And, it's not just even if you look at tech shares have got expensive. We're saying it's probably unjustified because the earnings growth is going to slightly disappoint. But if you take the red line, we've stripped out the tech shares out of the US market, and you can see the PE is pretty much back to where you were at what was a massive bull market top. It took you, and took you to, many years. I think it's sort of about 2014, 2015 before you got back to those levels. But on terms of price of the market, you're back to those same levels now. So that's more the earnings, the PEs were kind of top of the market prices, not bottom of the market. So shares are fairly expensive. You look at financials there, these companies are expensive. Now the environment, apart from you've got a whole lot of customers who don't pay you back, go sour on their loans, excuse me. Low interest rates are horrible for banks because they take an interest margin, and your net interest margins take a hit. So it is just making the point is equity is very hard to be a bull market from here. Simon, I don't know if you want to take that one while
no, definitely. So the interesting thing is if we just zoom out a little bit and you kind of say, okay, the earnings growth number there, that blue line, is what the consensus expectation was for earnings growth over time for 2020. So obviously the blue line in 2019, no one knew about coronavirus. So last year, everyone thought they were going to get about 10% on average earnings growth in the S&P. And you can see the market happy to pay 3,200 roughly for 10% earnings growth. Okay, well now with coronavirus and all what's happening, that expectation, instead of getting 10% growth, you're now getting minus 25% growth. But you're still paying the same price. So effectively, you're paying the same price, but instead of getting 10% growth, you're getting minus 25. You're getting a whole lot less, and you're not getting a discount. So in our view, that's a bad deal. The 10% growth looked nice, but at minus 25, we'd rather not buy that asset.
Not a lot of upside, quite a lot of downside. South Africa, similar picture. That's across the various sectors, earnings growth forecasts. And then again, you look at, most companies are coming out and saying, because this is what they have to do, we expect earnings to be at least 20% down, but we'll tell you closer to when we actually report. But when you start to push through the numbers, the earnings are going to be a lot more than 20% down. And there's a combination. The bank's down 30%. We think they're going to be down even more across the various sectors, the SA Inc. sectors. This is quite an interesting one because if you look, just take the SA Banks Index, being the red there. If you just looked at the index, it was at close to 9,000, 10,000, and it's now 5,000, 6,000. So you'd say, wow, bank shares are super cheap. Never seen them so cheap in my life. But if you actually look at the price earnings ratio of banks, based on the and we think the earnings declines are going to be more than the market's forecasting. But even given what the market's forecasting, you at 9 times earnings. Banks are not cheap. That's the blue line here. And there's a lot of headwinds for our banks. It's going to be a tough couple of years, not just 1 year, tough couple of years. Locally, the government got in a very difficult situation. The opening up isn't because coronavirus has gone away. It's just because the economic damage is becoming too big to really carry on locking down. The hard lockdown didn't work, so we might as well go back and do what we do. Still a massive drag on the economy. Similarly, there's our equity prices stripping out, essentially in SPAS. We've had some recovery. We're back to 20,300 on this index, but there's where earnings are going to go. The ex-tech, it's a tough environment for our local shares. You know, so one of the ways we're just trying to describe it is this concept of in finance terms, dead cat bounce. Something falls a huge amount. It's like dropping a dead cat off a building. It would bounce. It doesn't mean it can fly. And we're seeing a lot of these headlines coming through. You know, US retail sales rose record 18% in May. You know, wow, retail sales. You would read that and you'd think the market's pumping. You know, it's sharply higher jobs report. You know, the massive increase in jobs created in the US, and some of it's this massive fall and then a bit of a recovery. And you can see that there in retail sales. There's this massive fall down and some recovery back. But you've got to kind of look what's actually going on in those numbers. There's the retail sales, there's some recovery. Obviously, the economy is not going to stay shut. People have got to go out and buy stuff, and there's that activity carrying on. But you're still, relative to the GFC, you're still a lot worse, and there's still this rolling secondary effects of the recession coming through. Now, what's happened in the US, which is in those retail numbers, is that a lot of sales have gone online. The red line there is online, and the blue is all retail sales. So retails or non-online. So the other sales and the online sales. You can see this divergence. So that's great. So you sell a lot online, but here's the problem. A lot of companies are not selling it online. And that stuff got better in you know, just look at the first one, clothing and accessories. It was down 87% in April. It's now down 63% in May. Now that's better. That's a lot better, but it's still absolutely shocking numbers. And you can see down the bottom here, non-store retailers have been up 25% year on year. But there's a problem in that. In one of the examples here, as you say, Target. Target is a big US retailer, similar, say, to Hypermarket, a probably similar comparison. Quarterly results are up 11% in sales. Fantastic. Market got very excited. The shares jumped. But if you look down the bottom here, a lot was sold online. Their profit declined by 65%, which is equity owners, we just have a share of the profit. And that's really worrying in the structure of the economy. Another one is employment. People got very excited about the US employment, May employment numbers being really great. The economy, it created jobs. But that's in the context of this fall. This is what we say, excuse me, this dead cat bounce in this is all employees in the US. And then there's a bit of a kind of comeback. Some stuff does open up. But you still got to look at the quantum of the hit is very important.
Maybe just to re-emphasize the point is economists' models aren't built to handle that noise in key economic data. So normally economists' models work on kind of autocorrelation. You know, if it went up last month, it'll go up this month, it'll go up next month. If it went down last month, it'll go down this month, it'll go down next month. That's generally how econometric type models on economies work, and turning points are very important. So once you find a turning point, that's significant in that if it was going down and then it starts going up, it'll probably go up. That's very crudely how a lot of economists think. But the current scenario doesn't work in the framework of economics, where everything just stops. What does it mean when you go minus 20 million jobs plus 2.5. The ability to kind of filter that through a econometric model just breaks. I think that's really important to understand, that we don't see the shape as being a traditional shape where after it stops falling and starts going up, therefore it will carry on going up. It could just be volatility, which is very abnormal in these types of numbers. You don't normally get volatility in these big economic data numbers. But given the disruption of coronavirus, you can get volatility in employment numbers.
Yeah, I think a good analogy in the South African context would probably be load shedding. You get 2 weeks of stage 5 load shedding. Everyone stops. Pretty much nothing happens. So that month, say it happens in a month like May. The May numbers look horrible. Then you start working again in June. June's going to look much better sequentially versus May. But the overall dragging your economy down, that damage is done and it contributes and makes an impact. You do have some bounce back, but you're still getting real economic damage when you have the stop impact in the economy. And that's relative to GFC. We don't think you're back on a period of economic expansion. You're going to get some recovery and you're going to get some carry on getting pulled back. And there's, unemployment, you can see dropped in the US down 15%, still now down 13% year on year. Though May was not as bad year on year as April was, obviously because everyone had stay-at-home orders in US. Same as South Africa. If you look at a level 5 lockdown, there's more economic activity at level 3, but it's still it's still tough. And this is the problem. Normally you have a decline in GDP causing unemployment. And this is why we're saying probably your best analogy here is of something like lockdown. The economy stops, to just assume you know how it works. And this is a good example we pulled out from one of the sell-side analysts, big firm, American firm, very reputable, couple of PhDs in the economics department, thinking hard about it. And this is mind-boggling, these numbers, because they've got percentage quarter-on-quarter SARS. So that's quarter-on-quarter, seasonally adjusted, annualized numbers, annual rate of return. And you can see the thing that strikes you immediately. Now, normally economists use big econometric models. They pump hundreds of numbers in here and they chugs away, spreadsheet spits out something. But you can see these numbers are all comma naught and they're all big round numbers. Basically, they don't know how to forecast it. You're just guessing. Sometimes you worry economists are just guessing. But in this case, it's really, really scary how thumbsuck those numbers really are. And it's not really being discounted in. Who is doing a lot of thinking is the Atlanta Fed. Now, this is not their forecast. This is an estimate. In other words, they take real-time numbers, all the things that make up a GDP forecast or a GDP report. So the next quarter will be end of June. It's now 22nd of June. And they put in real numbers. And this is what they're getting is minus 45%. That's quarter on quarter. So it's the second quarter worse than the first quarter. But it's still significantly worse than the real market's thinking about. So it's significant hit if you're putting in the real, these stats that the market is looking at, like employment and retail sales, they're putting them into massive models. And they're coming up with pretty tough economic environment. There are other risks and things on the horizon that we need to look at. The one that the market that we're all hoping for is that QE, quantitative easing, central bank printing money bails everything out. It's certainly, you could make a strong argument for everybody's just going to print money like nothing, from Malaysia to South Africa, never mind the Europeans and the Americans. So cash is trash. Don't have cash. It'll be worthless. It certainly is an option. It's one of the reasons why we've got very big gold holdings in all our funds. We've got close to 10% physical gold plus some gold shares. That gives a nice hedge here. It's been doing really nicely for us. One of the other places we're just managing to get the singles, but don't assume that QE always pushes up equity prices. And the two big scale examples we've got on that is Japan on the left there, and Europe on the right. So 2014 to 2019, In Japan, you can see that the blue line is a central bank balance sheet. So they did a massive amount of quantitative easing. And equity prices didn't really go anywhere. Europe as well on the right there, you know, I mean, we all read the financial press. Europeans since 2012 have been pretty much permanently on very low interest rates, negative interest rates actually, which is something we've never seen before. And you can see that's the stock 600, the average of their 600 biggest shares. It hasn't exactly gone anywhere.
Rob, we've had a lot of questions on QE actually, and I was just waiting for these slides to be able to answer. And so there's probably 4 or 5 questions. I'm going to try to cover them all in one shot. But very importantly, you know, if you just step back a bit, why doesn't QE fix share prices? Well, share price is a function of the earnings outlook for that business. So if QE doesn't create significant and profound economic growth, you don't get compounding earnings in equity prices, in companies, and so equities can't compound and trend upwards. So you look at the US has had good earnings growth. And it happens to also have had QE, but I don't think that QE was the driver of the earnings growth there. And Japan and Europe haven't really had the earnings growth that's been compounding in the US, and the equity markets have been going nowhere. So can QE fix share prices and help them to trend up into a bull market? No. Can they plug holes? Yes. QE can plug some holes. It can de-risk the market. It can free up some liquidity. We saw it in the bond markets, corporate bond markets earlier in the year. It can get things going, but it can't get equity prices to turn into a bull market. You need earnings growth for that. You need economic growth and earnings growth, which work together, as we've discussed. And that's really what drives equity prices up in a sustained fashion without taking a lot of risk. If you want to try and time the market and trade in and out on V bottoms and on the top back and forth, QE might be a nice environment. It can create that volatility and so forth. You can see Europe did rally a bit on the increased QE. From its very low, it went up a bit. But broadly speaking, over multiple years, it goes sideways because you've got to get economic growth. And so that's kind of our distinction, where if you want to be a short-term trader, maybe, a bit risky. But if you want to fix an economy and fix earnings growth and fix GDP growth, QE is not that good an instrument to achieve that. You need more broad reform and so forth. So a lot of talk, a lot of guys saying with QE, the market's just going to go up because the money has to go somewhere. I think when the market starts going down, there's always enough liquidity and cash. You'd probably rather be in cash. It's not forcing it long-term to just sit in equity. And the reason being is volume. It's something the market often forgets. It doesn't take a lot of shares for equity prices to fall. There's just no buyers, and there's quite a few sellers. Prices can fall a lot. Whereas to build a bull market over years, you need a lot of volume. And that distinction, I think, is important. You can have these markets that fall on low volume and can be quite nasty. So we're not relying on QE to bail out.
If the market was at a bottom, you possibly could argue that, but the market's at a top. And we see QE as pretty much like an emergency, very powerful drug in a medical context, and fixes specific things. So what really worked in Japan is it weakened their currency, which made companies like Toyota were breaking even, suddenly made really good profits because you made the yen quite a lot weaker against and an exporter. So that helped. It can fix particular things, but it can't cure everything. And if you're going to start taking it recreationally, it's not a good plan. You've got all sorts of side effects, and there's realization of that. If you just make another point, in Japan, they even bought equities, the central bank. And that didn't do much for equity prices, which is interesting. So these are the 2 large-scale examples we have of that, and neither of them have been good. Too much QE down the line causes inflation, and normally with bouts of inflation, initially equity prices fall a lot because you've got to start putting up interest rates. So it's an open question but the point is, I think relative to most of our competitors in South Africa, we probably see this a bit different. But internationally, if you see some guys that firms that you really expect, like I was reading something on Jeremy Grantham, which is really great commentator. There's quite a few you've seen. But the risk reward doesn't stack up, and that's where we might be wrong. That's why we good combination with a lot of those funds that slide Brian had on the correlation matrices. We could never say absolutely 100% sure. Just shares are very expensive, and the market, the earnings are horrible. The economic outline out there, the Fed will lend you money. This is just a survey that the Atlanta Fed does in the US. Your bank is not going to lend you money. And it's small. This is small firms, large firms, similar thing. Your bank's not that keen to give you a loan. So which is a problem. The other one is you've got this pandemic, the waves coming. You can see in the US, states like Florida and Texas opened up reasonably aggressively, and they're getting a massive increase in waves of coronavirus. To control it, really, you need to do what China does. If you find 5 cases, you lock down a whole city, a whole neighborhood, and track everyone. But you need to be running a bit of a police state to be able to do that. So you've probably got these scenarios where you're going to have big waves and surges and more lockdown. And I don't think the market's ready for that. The market's positioned for, okay, crisis is over, let's carry on. One of the other things, you're only really out of it when you get a vaccine. And vaccine is early next year. There's a Chinese one, which I think they had some volunteers in the military who volunteered to do it. But the problem with the vaccine, you need to be giving it to billions of healthy people. It's not if you at death's door, yet try anything. You can take some high-risk medications. You can't go and give a vaccine, because if you, in the swine flu in the mid-70s, the side effect, and was worried about it was going to be a very deadly flu, the side effect was Guillain-Barré disease. They rushed through a vaccine approval, and the side effect unexpectedly was Guillain-Barré disease, which is that when you slowly go paralyzed, your whole body gets paralyzed, and eventually on the breathing apparatus, and then it recedes. A massive, horrible disease. And you can have that type of thing with injudicious, with no testing on a vaccine. This is another important point to note. This is share buybacks in the US. Track the number monthly, and this has been the biggest net buyer of shares in the US. Because of aging population, there's been probably net selling from individuals and funds. That's gone down. You can't see it there, but it's gone down to nothing in May. The little tab there. So I'm going along at a nice 50, 60 billion a month. It's gone down to nothing. Now, this is important. This is companies. They're telling you what they think of this rally. Not the chance that we're buying our own shares. In fact, can we sell you some shares? And we can see that last week, Foschini did that in South Africa. We're not doing an acquisition, but hey, our share price is halved, but we're going to place 20% of our market cap with the rights issue. And that's what the guys running companies. I've run a listed company. You can see the logic. They're not saying, well, goody, the crisis has passed. They're saying conserve cash, build cash, and you've seen the same thing. Huge bond issues and a lot of equity issuing around the world. So the supply of equity is actually going up a lot, and there's the demand, and it's not getting mopped up in share buybacks. And then, not to forget, the trade war is an interesting one that's not good for global economic growth, and is potentially inflationary down the line. And it's got very toxic between the US and China. Another big one, we probably spent too much time thinking about the US election. We should think about our own one end of next year for the head of the ANC. But Joe Biden's probably going to get elected. Why is that? That's him with the blue, Trump with the red. Why is that important? Because he's proposing $1 trillion of new corporate taxes. Now, if you remember, we had the Trump bump. When Trump cut the tax rates, there was a big kick up in the equity markets because the US tax rates went down from 28% to 20%. Biden's putting that up plus more. That's not nice for stock markets. Stock markets don't, because the earnings that you're left with then are cut even more. And that's not even vaguely factored in any of those earnings estimates. So coming back to this, where we started to some degree, that's our market, that all Z, that's the roadmap. We don't think it's a start of a pumping new bull market. We think you got to be opportunistic, and you'll make money, but just you need to be flexible, and you need to be active allocators when the market's bombed out and the risks have abated. then it's a great time to be making money for the clients. But don't try hit those big sixes. Just chug away. There are singles on offer. You can take those and keep the scoreboard ticking quite nicely. We think it's just, in short, it's another opportunity to de-risk portfolios. I know Simon's tracking the question flow. And
yes, Jan, I'm trying to manage it. Quite a few questions coming through, so hopefully we can answer as many of them as possible. One of the key things is kind of the Paul's asking, where to from here for new money. Well, so we think that there's still quite a lot of risk in the market, and so a fairly low risk strategy makes sense. You want to get that fund diversification, as Brian was saying, but for the funds we manage, in our best view, we're trying hard to be right, is to be sitting, and broadly speaking, we're sitting in very little equity exposure, very little risk exposure. We've got gold, so in a multi-asset environment, gold, USD, some US government bond duration, and very little South African government bond duration. That's broadly our asset allocation. It's a very low risk asset allocation. And then what we're doing is we're trying to take low risk singles. We're trying to make a little bit of return without taking a lot of risk. A couple of the examples that we've given in this presentation was we've moved the currency exposure in the multi-asset funds once and then back again. So when the Rand blew out, we said, look, it's oversold. And so we bought some Rands effectively. And then when the Rand kind of, I think Rob was in the media quoted at 1650, and we've learned our lessons, not waiting for your exact target. I think when it got to about 1670, we decided to sell some Rands and buy some dollars. And we moved a bit back. It's fairly low risk. We're not trying to become currency traders. We're just moving around with the macro. Same thing with bonds. When the South African bonds sold off the duration, we bought a bit. When they kind of had a big rally, how much is left in the trade? So you can hit some singles, but we're not piling into risky equities, taking a chance on Hertz or Sasol if it goes bust or doesn't go bust. We're not gambling, where you can say, well, I either triple my money or I lose everything. We're not trying to do those kinds of trades. And at the same time, we're very earnings focused. So we're saying, well, look at South African banks. They've announced that earnings are going to be worse than 20% lower. We think 50, 60% lower is probably a reasonable number for SA banks. And in a very earnings focus, we're saying, well, the valuation's not there. The risk is too high because everyone else thinks earnings are going to be down 30. So if it's worse than that, you're probably going to lose money. So we're cautious around kind of buying value at the moment as well on our outlook. And then at the same time, I know Percy was asking about the FANGs earlier. Buying the secular favorites is also risky, because they're expensive. So overpaying for something because it's a secular winner, whether you're selling advertising like Facebook, whether you're selling software and cloud services like Microsoft, you're still selling that product into the economy. Facebook, yes, it's new tech, but the person advertising on Facebook makes shoes. They're not a tech business necessarily. They sell shoes and they're advertising on Facebook. So if people buy less shoes, they're not going to advertise as much on Facebook. If banks demand less IT services, they're not necessarily going to pay as much to Microsoft. So kind of looking forward, we think there's a bit of risk there as well on our kind of asset allocation. Rob, I don't know if you want to add to that.
Yeah, and we're also working hard at trying to, portion in our global fund, hedging having some hedged equity, finding our best ideas, and then being short some bad ideas. So net exposure, it's not geared or anything that makes sense. Be making some money, but the main thing really trying to, I don't know if it comes across clear enough. It's patience. It's equity market is not a bond. It doesn't give you the same return every month, and the entry point that you get in is important. And we feel, we're well placed to pull the trigger. And that's our clients have done well trusting us with that over the years. We won't always get it exactly right, but we're kind of thinking about it the whole time. And I think that takes a bit of the strain off some advisors trying to work out where to get in. The funny thing in South Africa, which is rather different, is first you've got so much in asset allocation portfolios, but so few people are trying to do asset allocation. A lot of people are just, let's just have a static asset allocation, move it around a couple of percent. And I think it's important. We need to be able to do, portfolio managers, investment companies need to do that for the clients and be judged at how well you do it. And so there will be great opportunities. We just be a bit patient. Just sit on your hands a little bit.
Yeah. Probably time for one last question, then we have to wrap up. Ken, just kind of summarizing there about QE. And I think we're debating this a lot internally. So what can QE do, and where will it fail? And I think, we're talking modern monetary theory. You just print money and don't worry about it. Distribute and print money, just helicopter money kind of stuff. The big risk, and you'll see if you actually read the details, when the US Fed speaks, the biggest risk about these low interest rates, they worry a little bit about inflation. And obviously, central banks are very inflation focused, but you can measure inflation and you can manage inflation and you can see it coming. The biggest risk for QE are asset bubbles. And the sharp guys in the Fed, when you read the details on page 6 or 7, not the headlines, they talk about asset bubbles a fair amount and they worry about them. And that's the big risk. So to Rob's point, you've got to be patient. You've got to look at the risk return outlook, but the market can carry on going up. You got to check your facts, and you got to have conviction through that. Same thing goes for the dot-com bubble. People that sold out early, people shorted the market and went bust. It can carry on going up for a while, as long as you kind of got the facts and you focused correctly and you've got the fundamentals right. Eventually, it comes through. So although we think, another opportunity to de-risk, can the market, due to QE and all this money being printed, go up from here? It is possible. It can tick up, but we think it'd be a very risky trade to follow it up, i.e. to invest with it going up, invest with the easy money getting pushed into equities, because underneath that, there isn't the earnings to hold the valuation. There's no floor to it. So it's a very risky trade to chase it up. And we think balance of probabilities, the economic numbers come out and they're worse than expected, and that the market actually is in a bear market. It's not a new bull market. So I hope that answers that a bit, Ken.
Yeah, an illogical market, there's that saying of Keynes, John Maynard Keynes, of the market can stay irrational a lot longer than you can stay solvent. Now that obviously applies if you using borrowed money and running very geared positions. We're not geared. We can't gear our positions. We're not allowed to. But we can be patient. We've got that luxury of being patient and waiting for reality to set in, because we really believe markets in the short term can be really irrational, and we believe they're being that now. But medium term, and that changes over what time span, and they actually are that discount the economic reality, and we see that coming through. And just picking up a bit on what Simon said, the Fed's doesn't want the market to go up 30% from here. Asset bubbles are a big problem to them. So they're not trying to fuel, they're trying to stop there being a plunge in assets. But now, so they don't want to pump the market another 30%. In fact, they want to just moderate it. So your upside is pretty limited. And in these cases, when markets are pretty irrational, given the underlying economic fundamentals, they can discount that the true fundamentals very, very quickly. And that looks like a crash. You get this massive, oh my gosh, things are worse than we thought. And that can be problematic. Time-wise, we're running a bit out of time. But obviously, me and Simon can carry on answering a couple of questions. I know, Simon, you can see the question flow. Obviously, anyone who has to go off under time pressure, that's great. Thanks you for being there. You can just exit. But we can probably go on another couple of minutes asking some of those questions. We had a brilliant turnout, and thank you for the support. We just want, in case there's some really great questions, but also something, if you kind of just send us through some questions, chat to us. It's a great time to we can actually do some follow-up calls and talk to you just on some particular issues where they might need a bit of to and fro rather than just one question, and it'd be great and really nice opportunity to talk to our clients. So thank you. So just go, if you have to go, just go off. We'll answer a couple more questions. Simon, are there more?
Yeah, we've still got a few more questions here. Yeah.
So we'll carry on answering them a bit, but thanks for your time if you have to go.
Great. So a couple of questions here on bonds and income funds. This one from someone whose name hasn't pulled through, but how are you thinking about pensioners and with income draws? That's a really tough question because obviously, you're getting about 5%. I think money market's about 5.1. I checked this morning. Interest. You could kind of believe government numbers. Is our inflation rate going to hang around at 4.5%? I think the real inflation rate people feel is sometimes very different to what they see in the newspaper. So what can you do with 5%? Not very much. So how do you solve this? How do you square the circle? We think active asset allocation is a really important tool, even in the low risk environment. And so the stable fund, although it takes, in total, it always takes less risk, it's still a very active fund, and there will be opportunities. So it's okay to sit in earning 5%. At the moment, our stable fund, the Rezco stable fund, is invested in SA 2023 bonds and Tier 8s, which actually mature in March next year. People don't talk about them too often, but they mature in March next year, government bonds. So we're sitting in a lot of kind of effectively low interest, low duration type of instruments. We don't always want to be there. We think that there'll be an opportunity in a stable fund to buy a bit of equity at some stage, or to add a bit of duration. It's got some gold in the fund as well. So there are opportunities. But the key thing is, what can you do? You can take 5% and you can try add a few percent to it in this environment. I think that's a realistic outlook. 5% is your base interest rate that you can get money market. And if you can make a couple of percent here and there, I think that would be a reasonably good outcome. I don't think you can get much better than that unless you take a lot of risk buying companies hoping that everyone else ignores the next couple of years of bad earnings. So this idea that 2020 doesn't matter, 2021 will already be in a recovery, and so just ignore 2020 and you'll be fine. It's nice if everyone's playing that game. Fantastic. Everyone, let's all do this together. Until someone says the emperor's not wearing clothes, and then you go, oops, okay, 2021 earnings aren't as good as we expected. 2020s were worse than expected. And all of a sudden, this idea that you can just ignore earnings, you can just ignore the coronavirus, and the fact that economies were turned off, all of a sudden doesn't work. And so that will produce opportunities, we think, and volatility. The shares will come down. But for now, risk return wise, we staying pretty cautious. We're not chasing equities up from here, and so we temper return expectations, and that makes financial advisors' jobs quite hard, because we know what that means. It means kind of tough conversations sometimes with clients that were used to 15% returns compounded. I'd temper those. I'd temper expectations right down into inflation plus a little bit in the short term.
Yeah, we said obviously through the cycle, because I mean that fund's running at, I think the year on year is about 12%, and by moving between the asset classes, you can find the returns. So it did really nicely out of its currency, moving around, but some money on the bonds, been making some money on the gold. So we think a multi-asset fund, low equity multi-asset fund is probably your best bet. And that's certainly, if you look at that 3-year track record, definitely the case. Be a bit careful on having too much bond duration. We'll know what happens on Thursday. It could be anything. But the flexibility of that, I don't think the answer is putting your money on fixed deposit for 5 years, because we could fall in love with quantitative easing in South Africa, where we could have hyperinflation. Which is very dangerous, and we will face, ultimately the underlying client says, what I need you, my financial advisor, for, because I can just put my money in the bank on 5 years fixed deposit. Very dangerous thing to do. The prospects of we could have an Argentinian type of event where your money becomes a bit worthless, so you can't give up your ability to have your offshore exposure. In short, we rotating between the asset classes is probably your best point of best way to get the return. And then there will be great opportunity. We're not just permanently bearish. We're just saying, well, right here, what's the point? You're going to be disappointed on the equities.
Yeah. So Ian's asking about why we're so negative on government bonds. I think Rob touched on that. Just to make it clear, it's some kind of inflationary environment is not our base case. We're not saying our base case is hyperinflation, but we're a small emerging market, and you've got to take tail risk into account, negative tail risk. We live here, so we can be, it's sometimes tough to think about that, but you see it in other countries. And there's a very low probability of a high risk event going in this kind of environment now in South Africa, where you have relatively benign type inflation, the SARB saying they think inflation stays around 4.5 for the next 3 years. And there's a risk that you get this kind of interest rates too low, and you get this inflation coming through, currency weakens, and there's this tail risk because you can't just spend money and not reform the country. And so our local government bonds, with the kind of budget deficits, with the way the country's sitting, you do have risk of a stagflationary environment and some kind of political stagnation or risk that makes our government bonds a bad investment. And so we see South African government bonds as a risk trade when there's a lot of duration. You take a 10-year, 15-year view on South Africa as a country, it's probably a riskier investment than taking a 10, 15-year view on a global, well-managed corporate. And so you actually see that in the way that the prices move. That's why you've seen the All Bond Index have that big drawdown early in the year, because it acts like a risk asset. It doesn't act like a risk-free asset. Because we're an emerging market. And so we're very cognizant of the fact that in South Africa, when things go wrong, equities and bonds correlate positively. And we build the portfolios around that logic, that you're taking risk when you invest in a 15-year South African government bond. Is it a good risk to take? We say our balance sheet as a country doesn't look very good, our outlook doesn't look good, and therefore it's not a very good long-term risk where we're sitting now. But that
if I can just chip in there on that, when the day Moody's downgraded us to junk, the long-awaited downgrade, and we became officially junk, we bought a lot of duration. And we kind of rode the duration, but then when you eventually look at it, and it's same with us, Mexico, Brazil, similar kind of picture. Eventually, there's not much left in it. The relative to spread to US Treasuries, you've kind of done. You're back to where you were middle of last year, maybe not quite there, but you always got to leave a little bit for the next guy. Otherwise, he won't buy it from you. And so the upside was kind of gone in the trade. We're going to have a midterm or emergency budget on Thursday. Budget deficits are probably blowing out to 12, 13%. Can you own government bonds in that environment? Particularly after you've had a great rally, we'll just say, well, there's not a lot of upside. We might as well park on clients' money and we can buy something when there is some upside. That's what how our thinking works.
So a couple of questions on the outlook for equities with a more kind of medium to longish, kind of 5-year view. That's a really tricky one. So I don't think you have to predict the 5-year correctly, given the kind of change in regime we're going through with coronavirus, with kind of the recession and so forth. On a 5-year view, if given to current valuations, if we have a horrible recession and you're back to where you are currently in 5 years, that would be a reasonably decent outcome. Assuming kind of the recession and that flows through the way that we would expect it to. That being said, it doesn't mean that funds have to move sideways for 5 years. So that's where our point is on asset allocation. If you're sitting out, the market could have a nasty dip, kind of a bear market. It's unlikely, I think, that the bear market lasts 5 years, which was kind of a part of that question. I don't think the market necessarily trends lower for 5 years. Bear market can last a year or two, probably the more likely time frame than a 5 year. That 5 years is like a depression, which I don't think we're calling for a depression at the moment. We think it'll be a bad recession. quite a noisy, protracted, volatile type recession, but a bad recession is our view, somewhere on a GFC, slightly worse maybe, type scale. Of course, not a financial crisis, a different type of crisis, which makes modeling it against the financial crisis probably a decent analogy, but not perfect. So yeah, so our 5-year view is fairly cautious. Our 2-year view is much more negative in that we think that in over 2-year view, you could have quite a lot of downside.
An important point to make
yeah.
on that is we you know, if you fixed asset allocations, then we think that's a great question. We can be active, you know, so we don't have to take we don't have to like say, well, that's 5 years, we locked in. We try to work, you know, invest for the longer term, but we need to see, you know, there's a Warren Buffett analogy, which is another great one. I love his terminology. He's got a vivid imagination. So when the tide goes out, you see you swimming naked. And that applies to companies, it applies to economies, it applies to whole industries. What's the hit look like that your underlying businesses and the economic structure, how much does it go up? What does the picture look like? And we can't wait till it's in the newspaper, the company publishes their results. You know, if you just take corporate fraud, the Germans have, you know, another company, DAX company called Wirecard, it's just apparently there's $2 billion just missing. Again, the CEO's first name is Marcus. So German investors are probably a bit touchy about CEOs called Marcus on the DAX. But it's symptomatic of the kind of thing you see here. The problems can come out and economic stresses get amplified, both for companies and whole markets. So you can afford to wait and be flexible. We don't have to, we have the flexibility being a mid-sized manager that we can do that. You know, in hunting analogy, if you've got to take the shot from 400 meters, you've got to be a jolly better shot than if you can take the shot from 100 meters. We can take the shot from 100 meters. You still got to think, you still got to plan, you still got to be really alert, but sometimes you just don't know that far out what the damage is to the businesses and to the underlying economies, and you can afford to wait and be opportunistic.
Paul just asking a question with regards to the Rand, you know, with all this kind of, you're saying growth in dollars, you know, it's all this QE, doesn't make the Rand look good. And it's a great question, Paul, because in the short term, yes, the Rand can look relatively good. And we've got to be careful of that because fundamentals do matter over time. But in the short term, currencies move on sentiment. So that's something we track really closely as part of our process, is we don't just look at South Africa with kind of blinkers on. We look at kind of all EMs and what all EMs are doing, because you get a lot of indication on kind of global sentiment, the flow of money back and forth. That's a really important driver of the Rand. So this recent Rand kind of, I won't call it strength, but kind of a bit of a bounce in the Rand from 19-ish down to 16, 70 odd. That was all just an EM sentiment kind of risk on type rally, nothing to do with us. So to your point, but when South Africa or any EM country comes out with any bad news, i.e. when the fundamentals are printed, sometimes that can de-link an economy from the global sentiment. So if we bad enough, we won't be traded in the basket, we'll be sold actively. But if we just broadly, roughly in line, then we're okay. You saw something similar in South Africa, you know, with Nenegate, post-Nenegate, and with the whole issues around Gordon. South Africa, SA Inc. did really well because there was an EM risk-on rally. The news it wasn't bad enough to de-link us. But then when the economy started printing really bad numbers, you saw our equity markets de-linked a bit. Fundamentals matter, but not over very short periods. And sometimes the global environment's more important. We think that South Africa on its current trajectory has some risk in the kind of on a 2-3 year view relative to what global markets are pricing. And that's why we're pretty cautious, as SA government bonds as an example, because we need to get through a really, really tough recession. We came into this in a recession, and we came into coronavirus while in a recession. Whereas a lot of other countries came in strong. We came in kind of very, very weak. And so we're very cautious around how we come out of this. And therefore we bias to being kind of risk averse around Rand and SA bonds. And we also just think from a South African investor perspective, utilizing some global diversification makes a lot of sense from a risk management perspective, not necessarily chasing better returns, but just risk management.
Yeah, it's flexibility. I mean, that's really what we really advocate and what you can do well in particularly if you know, low equity funds, but asset allocation funds should give you that flexibility and diversification of your return streams, which is, I think, in this environment, even more important to investors, because there's just so many scenarios that you've got to kind of try to think about. You need flexibility on the one hand and diversity in your portfolio.
Quite an interesting question from Ken Axel, just on stable funds. You know, we found the debate around risk in South Africa really interesting, because, you know, in South African context, a stable fund, how do you think about risk in a stable fund?
Yeah.
It's interesting because you could see what the industry does through the ANC elective conference. Okay. If you think about risk purely as kind of volatility, then you're missing a lot of the risk that's inherent in financial markets, because it doesn't help you in big event type issues. And so you can see a couple of scenarios. You can see that I'll talk to the underperformance first. If you look at the stable fund, now that's an SA focused fund, and you're going into the ANC elective conference 2017, Ramaphoria early 2018. And you say, okay, we did the work. You got 50-50 chance that you get a bad outcome or market negative outcome. Depends on your political views if it was bad, but certainly market negative outcome or market positive outcome. Okay, that's a lot of risk inherent in SA bonds and SA Inc. And over that time, we weren't so worried about volatility, because at that time there was EM sentiment was really positive, and so SA Inc. was expensive going into the ANC elective conference, and so we de-risked that portfolio a lot. And you can see we actually underperformed, because we're glad Cyril won. We underperformed a bit, but we did protect. You know, if the outcome was the opposite, we would have protected our clients' wealth very well, and even in dollars, our return wouldn't have been terrible. It's hard to know what would have happened had the vote gone the other way. So volatility had nothing to do with the risk then. Volatility didn't show you what that risk was. And the same thing goes for the coronavirus. Now you can see that's a risk that actually did happen and that we were positioned for. We're positioned for both risks. One happened, one didn't. And you can see that volatility didn't give you any signals going into it, but you just had this massive drawdown. And that's the type of risk we worry more about: big drawdown event, mispricings, overvaluations, sentiment that's just run too hard and too positive. That kind of stuff, we worry more about that. And we try and position for it. And so you can see how the fund performed through that. Now, going forward, what are the tools in the toolkit, and how are we going to get, kind of, you're asking, how are we going to deliver returns over the next 3 years? Now, very important to understand Rezco is we're not just a fund, we're not just a kind of a company that does well when there's a crash or a crisis of some sort. We try and position for them logically, but we actually like bull markets. We very much like bull markets when they're based on good common logic. We like bull markets, and we can do well in bull markets. What are our tools for the next 3 years? Well, we don't think we're going to have a bull market, so we think the market's going to be a tough market. Our tools are our flexibility, our active asset allocation, taking low risk and small incremental returns within the fund. So you end up working really, really hard. You do relatively little, but you take a lot less risk and you make small incremental returns. And you've got to be patient in the ups and downs of the noise. And we think that's the key return delivery mechanism for the stable fund. So we obviously, I mean,
if I could just chip in there what Simon's saying, we don't think you're going to have a bull market from here. You could have a bull market over the next 3 years, but it's not starting at these levels. You know,
Yes,
the market
sorry, yeah.
could be a whole lot lower, and then you could have started a bull market, which we would be wanting to participate aggressively. It's not necessarily just right off the next. You've got to be sitting alert, poised to do that. But from these levels, we're just not where a bull market starts.
Yeah. So if the market has a big correction, then of course, you know, our funds can, if we view that correctly and we buy, obviously the returns could be better potentially, if we kind of could buy things at better valuations. How things stand at the moment, we think there's a lot of risk to jumping into kind of risk assets at the moment. Great. There are still some other questions. I don't think we can answer them all. So there were over 300 people on the call, so you can imagine I've got some unanswered questions. I'd love to be able to go through. I think a lot of the questions that are unanswered have been broadly covered through the presentation. So I think we could wrap up there, except the one last question from Wesley, which I think we haven't discussed. It's just kind of on the US side. It also links to some other questions we've had around inflation. How do we see US Treasuries? US Treasuries behave differently in a kind of in a risk-off environment than SA bonds. So in SA bonds, I said we're risk assets. US Treasuries are the opposite. When there's a big market crack, US Treasuries do well. Okay. That being said, to Wesley's question, I think there's another couple of questions on inflation outlooks. With all the printing of money, you do get inflation risk over the next 3-5 years. It's going to come back. Inflation's not dead. You can't just print, what, 8, 9, whatever the number, $1 trillion over the next few years, including what's been printed, and then have no inflation. Then you get to the situation where why work, just print money. We don't think it works like that. That being said, in the short term, because we're cautious around our risk view is fairly cautious, we think there's potentially in the shorter term some opportunity around US Treasuries. I wouldn't have a huge allocation on them, and that over the medium term, you've got this inflation risk where if inflation comes back and you've got these ultra low interest rates, you've got a big problem sitting in US Treasuries. And as you've seen in South Africa, bonds aren't risk-free. You can lose a lot of capital in bonds if the views on interest rates and inflation rates change dramatically. And given where US bonds are priced, that risk is more extreme because they could reprice a lot lower, i.e. price in higher interest rates for inflation on a multi-year view. So we think there's risk in US Treasuries. But
that's one of the big side effects of the China-US trade war is most corporates are understanding they have to move their supply chain out of China. So China was a tremendous deflationary force because you could just make it so much cheaper in China over the last 20 years. It's now becomes an inflationary impact of having to find somewhere else to make your stuff. That's going to be a bit less flexible, less cost effective. That a lot of commentators are seeing. So initially there's deflation, but 3 to 5 years down, there's a prospect of inflation. Inflation long-term is good for hard assets like equities. Short-term, the experience is can be very tough on equities. If you look at some of the moves in the early 80s with high inflation, it's not automatic that the market just says, I'll hold equities with a 10-year view. It can be very tough on equities because interest rates have to respond and the gearing in the, so in short, you need flexibility to guide through it. You need flexibility and to be tactical and flexible. But I think we've probably got to wind it up there. Thanks for everyone else who stayed on. Obviously, if you've got other questions, just mail us. It's great, and it's always a pleasure to chat. And thanks very much for your time and the support.
Thank you.
Thanks very much. Just one more comment. Like we said in the beginning, we will be sending out a copy of this recording as well as a link to the slide deck. Rob, Simon, thanks very much for your time. Thank you to you guys as well for your time. We appreciate it. With that, we'll end the webinar. Thank you.